It's both interesting and hard to understand the world of wealthy investors. The people in this picture have become very wealthy by working hard, investing wisely, and being willing to take chances without fear. For most people, the idea of becoming a millionaire might seem like an impossible goal. On the other hand, people can learn a lot about how to handle their own money by closely studying the strategies and insights of these great investors. Today, we will talk about billionaire investment strategies. Looking at how billionaire investors think. To understand how billionaires make investments, you have to look into how they think. One thing that makes billionaires different from other investors is the way they think. Their way of thinking is marked by thinking about the long term, being brave enough to take risks, and having a strong belief in their own abilities to succeed. Here are some things that you should know about how billionaire buyers think. Long-term growth. When it comes to their investments, billionaires think about the long term. They don't get moved easily by short-term changes in the market and are ready to put up with volatility for the sake of long-term gains. One well-known example of this kind of long-term thinking is Elon Musk's investment in SpaceX. Even though there were risks, Musk's dedication has paid off big time. SpaceX is now worth over $74 billion. Strong belief in their ability to succeed. Billionaires have a strong trust in their own abilities to succeed. They are sure of their skills and understanding of the market, and setbacks or failures don't stop them easily. For example, Jeff Bezos put $250,000 of his own money into Amazon in 1995, which shows how much he believes in the company's promise. People with this mindset think about the long term, are ready to take risks, have faith in their own abilities, are open to new experiences, and are patient. Investors can improve their chances of doing well in the market by taking on some of these traits. Diversification. Billionaire investors know how important it is to diversify, both in their investments and in the way they think about them. Diversifying their investments across different businesses, asset classes, and even charitable causes shows that they want to minimize risk and make the most of opportunities. This way of thinking helps them handle economic downturns and take advantage of new trends, which is good for their long-term success. Be patient. A big part of how wealthy investors think is being patient. They know that buying is a long process, not a quick one. Even though the market changes all the time, billionaires stick to their plans and don't change their long-term goals. They know that short-term instability is just noise and don't let it make them make hasty choices. This method of being patient fits with the idea that getting rich takes time and careful planning. When you look at the way billionaire investors think, you can see that they have a unique mix of traits, such as a long-term view, a willingness to take chances, a strong belief in their own abilities, diversification, and patience. By developing some of these traits, people who want to become investors can develop an attitude that will help them do well in the unpredictable world of investments. Role of research in investment strategies. When it comes to investment plans, study is very important for figuring out where to put money and finding possible opportunities. When you do thorough research, you look into many things, such as a company's general financial health, growth potential, and ability to make money. A look at the basics. To find possible investment prospects, fundamental analysis looks at a company's financial statements, its management, and the overall direction of its industry. Investors can tell if a company is undervalued or overvalued by looking at its financial records. This information is very useful for making decisions. Signs of the economy. Another important part of study is finding and figuring out what economic indicators like inflation, interest rates, and GDP mean. These signs can have a big effect on investment choices. Investors can predict market trends and make smart decisions when they fully understand them. Looking at different investment options. It is important to compare different financial options in order to make smart choices. A comparative analysis helps investors find the best chances, whether they are looking at stocks in the same industry or stocks from different asset classes. Keeping up with news sources gives buyers real-time information about how the market is changing. Investors can stay ahead of trends, predict how the market will move, and change their strategies as needed by keeping an eye on business news. Working together and networking. In study, networking and working together are very important. When people work together, they can get useful information, different points of view, and chances that they might not be able to get when they work alone. Research plays many roles in investment strategies, such as looking at financial statements, knowing economic indicators, comparing options, keeping up with the latest news, and making the most of networking and teamwork. Robust study is the foundation of smart investment strategies because it helps people make smart decisions. Strategies for diversification. Diversification is an important part of any billionaire's business plan. Investors can lower their risk, get higher yields, and be financially successful in the long run by spreading their money across a variety of assets. Diversification is important, but it needs to be balanced with focus and discipline to keep from taking on too much and to make sure that financial goals and risk tolerance are met. Strategic asset allocation means spreading your money around different types of assets, like real estate, stocks, and bonds. The goal is to make a diversified portfolio that has the lowest risk and highest yield, diversifying the industry. One more important approach is to diversify across industries. For instance, Warren Buffett's Berkshire Hathaway has investments in a wide range of areas, such as energy, shopping, and insurance. Diversifying your business helps lower the risks that come with problems that are unique to your industry. Expanding into other countries. Adding foreign investments to a portfolio can make it even more diverse. This approach spreads risk across several economies, making them less vulnerable to changes in the home market. Stay away from too much variety. Diversification is important, but too much of it can make good assets less effective. To keep the stock manageable and in line with the investor's goals, it's important to find a balance. Figuring out how billionaires make their money is the key to getting rich, and variety is a big part of that. Focus and discipline should be balanced with diversity so that investors can use the power of a wide range of assets without weakening the effects of good decisions. The art of managing risk. A big part of how wealthy investors make money is learning how to handle risks well. They know how to find a good balance between risk and profit, but they are also willing to take calculated risks to get bigger returns. This is based on a few important rules. Diversification as a way to lower risk. Diversification is a great way to lower risk and increase earnings at the same time. Billionaire investors spread their money out among many assets, businesses, and places, so they are less vulnerable to any one risk. Protecting yourself. Hedging is another common tactic that billionaires use. To do this, you have to take options that balance out possible losses in other parts of the portfolio. One way to lower the risk of losing money is to buy a stock that you think will go up in price and simultaneously buy a put option, monitoring in real time. Billionaire investors keep a close eye on their investments and change their plans based on what they see happening in the market. By being proactive, they can quickly adapt to new situations and keep losses to a minimum. Pay attention to the basics. For risk management to work, it's important to keep your attention on basic analysis. Investors can make smart choices and deal with uncertain markets when they know about a company's financial health, position in the market, and growth prospects. Risks. Figured out. Rich buyers aren't afraid to take risks, but they make sure they're well thought out and well researched. They think about the risks and benefits of an investment and are ready to back out if the risks are greater than the benefits. When investing like a billionaire, risk management is all about finding the right balance between risk and return. Billionaires are very good at investing because they spread their money around, hedge their bets, keep an eye on things, focus on the basics, and are willing to take measured risks. Getting the most out of your patience. Billionaire investors put a lot of stock in the trait of patience when it comes to making investments. Billionaires who are good at trading know that it takes time, so they stick to their plans even when the market goes up and down. Billionaire investors look at the long term because they know that market changes are temporary. They resist the urge to move quickly on events that will only affect the short term and instead keep their attention on the main goals of their investment strategy. Investors who are patient don't make hasty choices, especially when the market is volatile. Billionaires don't make decisions based on their feelings instead of facts because they are patient and wait for the right chances. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.